Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, it's Jonathan Wu here, Senior Financial Advisor and Principal here at the SWU Group. So I thought to start the 2026 year off, we would have a look at a 2026 outlook. But of course, we can't have an outlook without having a 2025 year in review. And so I've asked a good mate of mine, Anthony Doyle, who is the Chief Investment Strategist at Pinnacle Investment Management, to have a chat about what happened in 2025, which was a very interesting year, given it's Donald Trump's first year in his second term, and how governments has reacted as well as central banks, and where does that leave the outlook for 2026? Because frankly, the last couple of years, equity market investors have been very happy and very pleased with performance, but will this performance continue? And this whole concept of the AI investment cycle, where every company in the tech sector is trying to create this God computer until they can, or they've worked out that they can't, what does that all mean for investors going forward? And whether or not it has any mirror image to the tech wreck we saw 25 years ago. So enjoy today's episode, talking about what's to come in 2026. And as always, remember to listen to the disclaimer at the end, as this podcast is for entertainment purposes only and does not give personal financial advice. Enjoy. Hey Doyley, welcome on the podcast.
G'day Jonathan, thanks for having me.
So let's talk about the 2026 outlook. We've had an interesting year. We're recording this in sort of the second week of December. Originally we had Trump's tantrums of different sorts, and then the market bounced back, and then we seem to be in this continuous period of everyone's making money in the equity market, right? And the growth momentum surprised everyone. We've seen recent US data show growth expectations drop sharply, obviously in early of 2025, and then rebounded again. Why do you think US growth has been stronger than expected, and do you think markets are still underpricing the strength of the 2026 growth outlook?
Well, the US has really been supported by two main factors today, which has surprised economists in terms of their expectations for growth. And one has driven equity markets higher over the course of the last 3 years, and that's the AI capex cycle and the amount of money and capital that the hyperscalers like Microsoft and Amazon and Meta are committing to building out the data center growth within the US. And you're talking about $500 billion. So that adds around 0.5% to GDP over the course of the next 12 months. And so there's another $500 billion next year as well. So it is extraordinary. That will add another 0.5% to US GDP. You've also, of course, had highly stimulatory fiscal policy. So Donald Trump has managed to pass through Congress the One Big Beautiful Bill Act, which will add another 0.5%. It's front loaded in terms of consumer tax cuts and corporate tax cuts. And so that's helping to support growth. And of course, generally, the labour market has been pretty resilient, and consumption is around 2/3 of the US economy. And if people have jobs, they typically spend.
Yes.
And they typically meet their obligations, debt obligations,
Yes.
like a mortgage or a credit card. And so what we're seeing is that spending has been stronger than economists had anticipated, particularly post-April, when there was so much uncertainty about what impact a higher tariff regime would have on the US economy. Put all of that together, and we're actually entering into 2026 in terms of the US specifically with really robust economic growth momentum, really strong. And so There's a now forecasting tool that one of the Federal Reserve banks, the Atlanta Fed, has developed using real-time economic data. It's all about big data now.
Yes.
And that's suggesting 4% year-on-year GDP growth for the third quarter. And so generally, when you have an environment of robust economic growth, well, then typically stock markets do pretty well as well.
So effectively, could we say that Trump's tariff regime hasn't done very much, at least domestically? We can't speak on behalf of other parts of the world, but it doesn't seem to have been a blip.
I mean, it's just been a really, really difficult time for economists and strategists because no one's really dealt with a regime where the average tariff rate goes from 2% to 20% overnight. And you're talking about the world's most dominant economies and trading partners in China and the US, and the relationship there, which has continually evolved over the year. And so markets will sell the rumour and buy the fact, as we know, Jono. And it's not to say that tariffs are not having an impact, they certainly are, but it's quite discrete in terms of the sectors and the companies that are being impacted. And so when you think about the S&P 500 in particular, it's dominated by tech firms. And tech firms aren't importing manufactured items from countries outside of the United States. And so with that in mind, when you've got 35% of the S&P 500, which are those Mag 7 type stocks, apart from Tesla and Apple, when I think of the Magnificent Seven, a lot of them have been pretty immune to the higher tariff regime. And actually, when you think about the laggards within the Magnificent Seven, it is a company like Apple, which is manufacturing items in offshore, China, for example. And so it's not to say that tariffs aren't having an impact, they certainly are. And I don't think we still fully understand or have fully seen the true impact and flow-on effect of higher tariffs, particularly on US inflation, for example. And it is something to be highly cognizant of. But one acronym that started to float around the market earlier in this year was TACO.
Yes.
Trump always chickens out. Yes. And, he's, I read his book, Jono, Art of the Deal.
Oh, okay.
And part of what Trump does is he takes a very hawkish position.
Yes.
Aussies will be familiar with it, and it's one of the biases. He anchors the negotiating party to an extreme position, and he eventually concedes, but he gets some way to what he wanted to initially achieve. And so when we think about tariffs, it looks like that Liberation Day placard that he held up for the world was a hawkish starting point where he was anchoring other countries to a higher tariff regime and eventually rode back from some of those higher tariffs in the fullness of time as we progress throughout the year. But certainly markets have evolved from being highly concerned around what does the future trade outlook look like, to one now where it certainly is AI is the dominant narrative within the market. And that's important for short-term investors in particular.
I'm going to park the AI bit for a second because there's a question about this theory of a God computer, right? So for the time being, everyone's pummeling money into this theory called AI to hopefully get to build a God computer. Let's park that thought aside for a minute because I want to sort of stick with policy. The other side of fiscal policy is monetary. So we've seen US, Fed cut rates. Australia's cut rates, but I think we're probably at the end of our cycle for other reasons with inflation. How do you see how the market's pricing in next year's US Fed cuts? And then how do you think that's going to flow through to the economy?
Yeah, it's been really interesting. And again, in an environment of heightened levels of uncertainty, you typically see less certainty around the future path of policy rates as well. So when you look at forward curves in terms of the bond market and pricing of interest rates going forward, the US has around 3 interest rate cuts within the next 12 months. The ECB is expected to remain on hold. The Bank of Japan, unlike other central banks, is expected to hike once or twice more within the next 12 months. And in terms of the RBA, we now actually have a rate hike priced in August of next year, following some sticky inflation numbers earlier this month. The first monthly inflation reading that the ABS has produced for October. So we're now starting to see the outlook, according to bond markets, for central banks begin to diverge. And typically, the course and the story of this year has very much been one of monetary policy accommodation. So interest rates declining, Bank of England, European Central Bank, Bank of Canada, Fed, RBA, RBNZ. So that's been a real supportive element for the equity market and equity market valuations in particular. Next year, I would suggest that tailwind from lower interest rates and easy monetary policy, that will begin to fade. And as a result, the market and investors in equities in particular will become a lot more focused on what is the earnings outlook for companies, as opposed to this year where we've described it as a dash for trash. And if you think about the NASDAQ in particular or the tech sector in the US, it's been unprofitable pre-earnings, pre-revenue tech firms that have led the rally. And that's what we mean by a dash for trash. There's no earnings there.
Like the tech wreck.
Exactly, yeah. So I think that we'll see a lot more discipline. And interestingly, what we describe as passive investing or beta, which is the market moving up and down as a whole, I think going forward, the equity market and equity market investors will be a lot more discerning as to the winners and losers in an environment where the cost of capital is higher and you don't have that necessarily that tailwind of lower rates coming through. So this year has been a fantastic year.
Yeah,
returns well above long run averages. You're talking about 16% in the US, around 18% for the MSCI World Index. It's been great region by region as well, whether it's EM, Asia, Europe, UK, discrete countries within Europe, the US. Actually, the laggard's really been Australia, with only around a 5% price return, and then you've got your dividends on top of that. But I think next year it would make sense for equity investors to moderate their expectations for full year total returns because of some of those tailwinds from rate cuts beginning to fade a little bit.
Now you talk about the dangers sort of going forward with passive investing. Can you sort of break that down a little bit? Because I think a lot of people just go, I'll just find the cheapest way to access the market, therefore I buy an ETF of the index, just ride the S&P 500 or ASX S&P 200. What is the biggest weakness of continuing to be a passive investor? Because as I understand it, the theory is that it's based on market weights and therefore it's backward looking, right? And if going forward, if CBA or whatever derates, you actually were overweight when you put money in. Can you sort of walk through what's the nuance of passive investing and the weakness of it?
Yeah, I mean, academic literature shows that the average active investment manager underperforms the benchmark. And so most passive acolytes would say, why bother? Why bother trying to outperform the index? Because markets are efficient and they know all available information at any one time. So you just invest in a passive way and then you will get a market return outside of paying a nominal cost for fees, depending upon what the index is you're tracking. But I would argue that will focus on a large tail of active managers that are suboptimal for whatever reason. And so my belief is that if you are a financial advisor or a retail investor or an institutional investor like a superannuation fund, part of your role as a steward of capital or looking after your own investments is attempting to identify those exceptional investment managers and active approaches that have a track record of delivering alpha or delivering excess performance after fees. And they exist out there. And if you can focus on those top quartile or top decile of managers that deliver those excess returns over a long period of time, well, then that's when you start to get compounding to work on in your favor. And so the passive approach today, the difficulty is indices generally, as you say, reward the winners. And that means that capital is flowing to the very largest stocks. The ASX is a case in point where the top 10 largest stocks represent today around 46% of the ASX 200. And so as an Aussie investor, most Australians have a home bias, which means we over allocate to the Australian equity market. And of course the superannuation funds do as well, with an average allocation to Australian equities between 20 and 30% for a balanced option. Well, largely that money is just flowing to four banks and Macquarie, CSL, Wesfarmers, Telstra, for example. And so it's not particularly well diversified. And you can see there that if you start to see any sort of difficulty in the outlook for one particular company, like CSL, which derated since August by around 30%, it can act as a significant anchor to the types of total returns that investors are looking for and seek to achieve from equities. It's not just an Aussie story. It could be the UK FTSE 100, the Euro Stocks 50 index, and of course the S&P 500 or the MSCI World Index. And when you think about, we've talked about academic literature in terms of passive investing. Well, academic literature also shows that building diversified portfolios is the most appropriate way to deliver long-term returns. This practicality that you can diversify your investments but generate a higher level of return with a less diversified portfolio of assets that's all correlated. And I would suggest that that's probably the most appropriate thing for investors to do, because the last decade, really since the GFC and since the reopening boom, since COVID, has been all about liquidity, all about interest rate reductions, and the tide lifting all boats.
Correct.
Well, I think now we have a risk-free rate, which will settle around 3%. There are regions that do better than others, there are sectors that do better than others, and there are companies that do better than others. And when you have a heightened level of uncertainty, whether it's around geopolitics or whether AI will persist and permeate through all our lives, that's when you get significant amount of idiosyncratic discrepancies within markets. And we've seen that with Europe's largest stock earlier this year, Novo Nordisk, which is a healthcare pharmaceutical company, produces what are known as weight loss drugs, what are known as GLP-1s, and derated around 40%, for example, because the earnings outlook deteriorated for Novo Nordisk because of the persistence of, they're not fake, but they're compounding GLP-1 weight loss drugs because there was a supply issue in getting the GLP-1 drugs out to users. So with that in mind, whether it's blending passive with active or a fully active approach, I think it certainly is prudent for investors today to think about their portfolios and what's going to work going forward, not what has worked well in the past.
Yeah, fair enough. Before we move on to AI, let's talk a little bit about the Australian outlook. It's really weird. I had dinner last night at a Chinese restaurant down south in Mortdale, and the manager, who we know quite well for the last 20 years, and he was like, "Oh, Jono, economy's pretty crap." And I go, "Well, yes and no." And I said, "What makes you say that?" And he said, "Well, the costs just keep going up and up, and it's like, it doesn't seem to be stopping, right? And look, there's only 3 tables here tonight on a Sunday night, right?" And he goes, and he said, "I don't even know how to outlook 2026 for, me as a small business owner. This is ridiculous, right? And, rates aren't going to come down anymore, and inflation's up again." Now, you then look at all the macro stuff that comes out. Growth doesn't seem to be that bad. Now, we know we've got a productivity issue. And then we had, I think, using my very simple mind, there was sort of like a 5% growth in retail spending recently. There was a figure that's came out. But then 5% looks good on the surface, but we've got 3% population growth. Then let's call it 2% inflation. You net have no growth. But I remember trying to get stuff for Black Friday, and a lot of stuff sold out really quick. My wife went to get some clothes. It's all, sold out. What do you think the true picture is for the Australian economy at the moment and into 2026?
Yeah, I mean, growth is very simple. As you say, it's productivity growth plus population growth. And then I always bring it back to economics 101 or what you studied in year 11 economics. Growth is consumption plus government spending plus investment plus net exports, so exports minus imports. And I think what we're seeing at the moment is a big disparity within those that are doing well in the Australian economy and those that are finding that they have to tighten the purse strings a bit. And certainly when we talk to consumer-facing companies within Australia, like JB Hi-Fi or Harvey Norman, for example, right at the pointy end of the consumer, they're definitely identifying trends of behaviour amongst Australian consumers where they're becoming a lot more discerning around price discovery, like Black Friday.
Yes.
They're waiting up for the sales, and then they go and, in order to save money, they're going out and spending then, as opposed to any other time before sort of the Christmas spending period. And it's interesting that the Black Friday sales have now sort of become a Black Friday month.
Pretty much.
As consumer-facing companies, consumer discretionary type companies are trying to incentivise individuals to sort of lighten those purse strings or
front load spending.
Yeah, exactly. And so when I talk about the sort of disparities we're seeing amongst the Australian population, it very much is those that have assets and those that don't.
Exactly.
Those that, are in the sort of pain trade, like myself at the moment, mortgage, kids, school fees, etc.
You're not Robinson Crusoe.
No. You're a younger person renting. Uni fees are up 20%. You're paying a mortgage because we do have higher rates than we were experiencing, obviously in the COVID type environment. Versus those that have assets have done very well out of, say, their home equity price with no capital gains tax, have a solid amount of assets in superannuation, maybe they own an investment property or two, they don't have a mortgage. And actually in a world of higher rates, then generally income producing assets like cash, term deposits, fixed income, all of a sudden generate a positive real return again.
Correct.
And so I think what we're seeing in the Australian economy at the moment is that you actually have that sort of wealth transfer occurring to some extent at an earlier stage in life. And, the so-called bank of mum and dad, which I've seen statistics on suggesting it's like the 5th or 6th largest lender in the land.
Yeah, not surprising.
So grandparents helping their kids out in terms of getting on the housing ladder, or maybe grandparents paying school fees and helping out in that way as well. Because certainly when you look at the costs of items of non-discretionary spending like insurance or gas, fuel, utilities, dental, healthcare, hospital fees, these are tuition fees, these have all materially outpaced the official rate of inflation since COVID. And what has biased down the overall rate of inflation? More discretionary type items, books, toys, audiovisual, telecommunications equipment, etc. And so I think, I've got my own index, which is how many people bring lunch into work every day in the Pinnacle office.
Yep.
I've noticed you, Jono, bringing it in a couple of times,
Yes.
but certainly there's a lot more people bringing in their lunch. And so anecdotally, I think that people are tightening their purse strings to some extent. But when you look at the overall figures for the economy, well, what is supporting growth here? Government spending. I mean, government spending is still firmly the taps are turned on, whether it's supporting the NDIS, whether it's healthcare, whether it's education. What we're seeing is that employment within these sectors has remained very strong, and actually the private sector has been shedding labour.
Yes.
And so without government spending as strong as it is, well, we would actually, we know that we experienced a per capita recession. We know we would be in a much more difficult environment. And you now have the population growth tap turned on again.
Yes.
And with that in mind, you're starting to see pressures build within housing again in terms of rents, but also the supply of housing as well.
Yeah. It's, as you talk about the Bank of Mum and Dad statistic, the other scary thing I saw, Vanguard came out with a report about 3 months ago around looking at how Aussies retire, and there's a statistic came out. They surveyed about 2,500 Aussies of different demographics, ages, and so on and so forth. Half of the baby boomers and Gen X are of the belief that when they retire, they will still have a mortgage. That's
Yeah.
quite scary. And the
Yeah.
rationale for that was based on the fact that they are drawing on equity to help their kids
Yeah.
get on the ladder, which is leading to a detrimental lifestyle for them in retirement. It's quite scary if it plays out that way.
Well, the average age of the first home buyer in the US is 40 years old now.
Really?
40
I think
years old,
Australia's 30, yeah, it's late 30s.
It puts
as
off
well.
household formation. It puts off people having family and kids, and that's a driver of economic growth as well. Household
Yes,
formation.
correct.
And so, I think from a society perspective, when you start to see income inequality grow to the extent that it is, and in particular when you see a generation believe that they're not going to have a standard of living that is equivalent or higher than their parents, that's when you start to see some of the fabric of society begin to break down to some extent, which is why you've seen the shifts to the left and the right across Europe and the US in particular, as income inequality has grown as a result largely of some of the monetary and fiscal policies that we've seen implemented post GFC, like quantitative easing,
correct.
where financial assets inflated, but real wages and employment and inflation obviously was quite high as well. It didn't follow suit, and that's the difficulty when real incomes are going backwards and people's standards of living are being eroded.
Yep.
That's when you start to see people start to think about, well, is there a different type of
Yeah.
party I might be able to vote for, one that will support my prospects going forward.
Correct. Let's go back to AI. So this whole theory of, and I'm raising this as a potential risk. I want to see if you think it is a risk. We're plowing this much money, $500 billion, as you said, into AI to build what tech companies believe they can build a God computer. And for the time being, they believe they can. I saw a figure, I think it was last night, and they said, we have now surpassed, in 6 months, we have surpassed the amount of money that was put into the Manhattan Project, which is the basis of the Oppenheimer movie, right? To build the nuclear...
In real terms? Or?
Yeah, in real terms.
Right,
in real terms, adjusted for inflation today, we have surpassed that. So imagine the mindset then of how much money we need to plow in to build a nuclear weapon. In the same way, this is like a God computer. There's an earnings risk whereby, as you said, you could be, I'm going to be very cheeky here, I'm going to pick on, Coles, and they all of a sudden say, we're using AI, and they announce that they're using AI at a company announcement. Share price goes up because they use AI, right? And then there are companies that don't make a profit, and then obviously that is a risk, which is the one that we alluded to from the tech wreck. Is there a potential risk whereby we plow so much, as in the world, plow so much money into AI, and then one day finding out we can't actually build a God computer? And then that just dissipates everyone in one hit and go, shit, that was a bad idea. Is that a risk?
I mean, in terms of the companies that are undertaking the CapEx, they're the most profitable companies in the world. And so when you look at CapEx as a percent of operating cash flow, it's only around 45%. It's expected to grow to 60 before tailing off again. But when you look at forecasts past 3 years, whether they actually materialize or not is a question mark. And so you look at more the next 24 months. And so CapEx as a percent of operating cash flow will rise to around 60% for the hyperscalers like Meta and Alphabet and Amazon, for example. And so they're highly, highly profitable companies. The question mark is the irrational exuberance that you see in pockets of the market. If you do start to see disappointments around the ability of companies to monetize some of the tools that they're building as part of this new technological innovation thematic that we're seeing, whether they start to get hit very hard and what impact does that have on shareholders. So we saw it recently with COVID. It was so uncertain, the outlook about what the world would look like when we were in lockdowns. What were the companies that did very well? Well, Peloton, we were never going to go back to the gym because we were too scared of getting a virus.
Yes.
Beyond Meat in terms of protein replacement. Moderna was going to solve all viruses. what were some other ones? We were going to Zoom
Zoom
forever.
forever,
We were never
yep.
going to meet again.
Yep.
All these companies have derated to the tune of 75 to 90%
Wow.
since reopening. And in the environment we're in at the moment, the outlook is uncertain in terms of the impact that many of these AI tools will have, not only on the consumer-facing front, but within organisations and in terms of their ability to generate higher revenues and earnings through productivity growth, and then the rollout to real-world applications like driverless cars, and even the benefits that AI will have in terms of the healthcare sector in identifying disease and improving mortality rates, for example. And when you get that type of environment where uncertainty is higher, the narratives can drive particular stock stories or sectors in particular. And as I mentioned, we saw it recently with GLP-1s, where the rollout of GLP-1s was going to cure diabetes and cure obesity. And I'm not sure if you remember, but there was even research done suggesting that airlines were going to benefit from weight loss drugs because the overall passenger load would be lighter.
And therefore,
this is some of the stuff. This is some of the stuff that was going around just 18 months ago, 2 years ago. You know, in terms of so it's a new technology, it's a new drug. The rollout, and in terms of the benefits of obviously having a lower weight is on comorbidities like cardiovascular disease as well, and heart disease, for example. And so I think at that sort of environment where it is so uncertain, it comes back to what financial advisors are telling their clients every day: diversify. You do want some eggs in that AI basket, but you also don't want to be all in the AI basket, because certainly there are risks in terms of valuations and the outlook. But there is also a risk that you are underweight that part of the market that has driven the market. And so you're leaving a lot on the table. And the opportunity cost of not being exposed there, I would argue, is as great as if some of these AI benefits don't, or they fail to materialise, or we don't see the earnings growth come through, or we start to see rapid depreciation of computer chips, for example. So from my perspective, it is a very uncertain environment. No one really knows. And in that type of environment, it's about diversification. So I want diversification by region, I want diversification by sector, I want diversification by investment factor, whether it's growth, value, quality, and I want to build this into a robust investment portfolio, one that can sail through the different types of scenarios that could inevitably occur over the course of the next 1, 3, 5, 7 years and beyond. I mean, for me, and talking to our managers at Pinnacle, our affiliated managers, I think you certainly want exposure to that AI thematic, but you want it in a very considered and discreet way, because as I mentioned earlier, if you're investing in those unprofitable tech names, that's really a coin toss, whether the earnings materializes and whether they grow into those lofty multiples of, say, 150 times. There is no earnings, so
correct.
There's
Infinity.
no PE. Yeah, there's no PE. And because certainly if you have been underweight or naked AI since ChatGPT was launched 3 years ago, that's a significant active risk that you've had in your portfolio. And you're looking at the main driver of your wealth going forward in terms of global equities or equity risk premia having not delivered for you in a world where the equity market's up 50% over the last 3 years. And up, as I said, almost 20% this year as well. And so it really comes back to the cornerstones of modern financial advice. Diversify, take a long run view, but be very active in how you're building portfolios, given the outlook for how the market might develop over the next few years. I would argue that the tail risks to the outlook have risen. And so there are ways that you can both protect yourself, but also benefit from some of these investment risks that have materialised, both on the upside and downside. Because one of my favourite lines from Peter Lynch at Fidelity, who wrote One Up on Wall Street, a book everyone should read, is there's more money lost waiting for the recession than in the recession itself. And in my view, recession likelihood is very low today from where we sit in terms of the outlook for economic growth in the next 12 months. And you don't typically get big bear markets unless you see a big deterioration in the labour market and a recession.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Let's sort of finish off talking about the other side of the investment spectrum, which is income. And I've had a bee in my bonnet about bonds broadly since COVID. And you have asset allocators that because of the way of their framework or their SA or whatever have to have an X amount in bonds.
Yeah.
And when rates were zero, bonds paid you nothing.
No.
Like, this is why we floated towards private credit.
Right.
When bonds were giving you 0 or 0.5%, we will get private credit at say 4.5%. Right. And this sector is starting to evolve quite a lot. There's been some ASIC activity as well. But if we start with bonds, now that we've got, sort of a terminal-ish interest rate of, as you said, 300 basis points or thereabouts, why do bonds matter again to you?
Well, firstly, it's the correlation benefits. As you say, when we were in a zero interest rate world or very low interest rate world, the yield curve was very flat to inverted. And so you weren't being paid for investing in bonds and what we describe as duration risk or interest rate risk. And in that type of world, it made no sense. There was a bond issued during COVID by the Austrian government with 100-year maturity, and it's lost 80% in face value since that issue date today.
Yikes.
But there was, again, academic theory suggested that interest rates couldn't go below zero. So there was a zero lower bound, but we were obviously proven wrong, where the ECB rate went below zero, and at one stage, you paid to lend to the German government. And the reason for that was the ECB refinancing rate was minus 50 basis points. The yield on the 10-year German government bond was only minus 10 basis points. So you were losing 40 basis points less.
Yes.
And so there were perverse and extraordinary things going on at that time. And again, the narrative was we were in a disinflationary, deflationary world, and this was likely to persist because of the overhang of debt and debt deleveraging, for example. And obviously COVID upended all of that to one now where very much the consensus view is we're in a structurally higher inflationary type of world, whether that's because of deglobalization or global aging, particularly in the West. And so workforces are becoming less efficient, and so that's structurally higher inflation, but also the view that China is no longer exporting deflation to the rest of the world as well. So these narratives permeate and persist through time, but where we sit today is firstly, fixed income is providing a diversification benefit to equities, which is exactly what you want, unlike say when interest rates are very, very low and equities and fixed income risk became correlated. Secondly, yield curves are steep, which means that the yield on a 5-year government bond is more than the yield on a 1-year government bond, and the yield on a 10-year government bond, and so on and so forth. And so you are being compensated for taking duration risk, whether it's in lending to the Australian government, the US government, or a corporate bond. All-in yields are compensating you for taking that risk, interest rate risk and credit risk. And so certainly the time to not invest in fixed income was exactly when you were saying, like public fixed income was exactly 2020, 2021, and we saw that 2022 interest rate repricing. We're now in a world where yield curves are steep, you're being compensated again for taking duration risk, and arguably the outlook for the US in particular is one of lower interest rates, and so that should support the capital value of your bond allocation as well. But you want it as a diversifier. I mean, the greatest tragedy of all is that the young kid going into first job gets put in a balanced fund with say 20 or 30% in fixed income. They don't need that. 100% equities because they're not retiring for 50 years.
Yes.
And so depending upon your outlook and your own personal circumstances, fixed income certainly has a very strong role to play in a diversified portfolio, particularly for retirees.
As an extension of that, private credit, has broadly, if we use investment grade public bonds as your sort of benchmark, private credit's paying, let's say, 200-300 basis points above that. Okay. And then so that's attracted a whole lot of capital in that direction too. And people say, oh, this is like the risk-free version of a bond. There's like no price volatility. I'm picking up income of like 7-8% today. It's like a free kick. Is it? And how do you sort of communicate that to investors that you speak to?
Yeah, I mean it's not risk-free for sure. The reason that it's paying a higher yield or a higher income is because there's illiquidity risk, but there's also more covenant risk that has to be assessed by the lender as well. And so certainly there aren't many risk-free assets in this world. Even if you put cash under your mattress, there's inflation risk.
Correct.
If you think about lending to the Austrian government for 100 years, you'll probably get your money back, if the euro still exists.
Yes.
But obviously there's a lot of interest rate risk. And so with the corporate bond as well, there's credit risk, and then you have, if you're lending offshore, there's currency risk. Now in terms of private credit, it has been a fantastic asset class. And when would I want to allocate to Aussie or Kiwi private credit? Well, it's when economic growth is relatively robust, unemployment is low, businesses are in a relatively strong position, inflation risk is relatively well contained, and inflation expectations are well anchored, and so default rate risk is lower as well. And the issue with private credit as a sector in Australia is that there have been a number of firms set up shop, and the space of private credit or the loans that they're making are often, say, sub 20 or sub $30 million in size. And that type of space where you're building a portfolio which is again not diversified, so it might just be purely to real estate developers in a certain city or a certain sector, I think that could definitely get into difficulty in an environment where you had an economic growth slowdown and you started to see that some of these companies weren't able to meet their debt obligations or loan obligations. In private assets and private markets, fund manager selection is more vital than in public markets because the dispersion that you see in, say, an Australian equity or a global equity manager in terms of the range of outcomes from a particular style or a particular exposure is typically less than what you'd see in private markets, whether it's private credit, private equity, unlisted infrastructure. It's very different, deal dependent, asset dependent, for example. So the type of private credit manager that I would be allocating to, I'm not an advisor like yourself, but you want to look for someone that has scale, someone that has experience, someone that's managed through different multiple market cycles, and someone that works very proactively with their borrowers, so they can sort of see off any difficulties before they occur. And finally, when it comes to our manager, can I mention a firm named Metrics?
Yes.
They're focused on businesses with $750 million of annualized revenues, of annual revenue, sorry. These are big firms, right? These are big companies. And so I have seen portfolios in private credit land of 10, 12 loans, very few exposures. We want something that's well diversified with low insolvency rates or low difficulties in terms of meeting arrears, for example. And so from my perspective, you want to go with sort of the blue chip private credit type managers, the ones that in a sort of downturn type scenario, they're actually going to do better because there's less competition.
Correct.
Less competition of capital. And so they actually do better in a downturn type of scenario, whereas the real sort of nervousness is coming from those smaller operators that may not be able to meet their redemption obligations in an environment where investors were to head for the exits.
I mean, I tell my clients very similar messaging to you. I mean, there is literally, 2 men a dog that's opening up a private credit shop every single week.
Well, you must see them. I mean, I've seen sandwich boards advertising high yields, and
and
it's too good to be true. It is.
And they just walk in and they say, oh yeah, we've got a deal for 300 grand. I'm like, what? Like 300 grand? Or how much do you want of this? I'm going, where you sourcing your capital from? Right, because that's a big issue for private credit managers. While the investor sits there and goes, "Oh, I'm picking up 7-8% every month. So this is easy," right? The manager's doing a whole lot of hard work to match inflows and outflows too.
Oh, totally.
Right,
Yeah.
and if you don't have deal flow, or you don't have investor capital, right, you've got real mismatch problems if you don't have scale.
Yeah. Totally.
So that's something that we've been focused on.
It's all about scale.
All about scale.
Yeah.
So, Doyle, thanks very much for jumping on for the 2026 Outlook.
Cheers, Jono. Thanks for having me.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.